Hi, I want to talk to you about something that you probably don't want to hear about, and that's the way you're doing your accounting for your company. And I'm talking about structural accounting, but I'm going to make this really simple so that you understand it. There are two different ways of doing accounting in your business. One is on a cash basis, and the other is on an accrual basis. Now, your tax accountant is probably doing your taxes on a cash basis. And the reason he or she is doing it that way is because they don't want you to pay taxes on money that you haven't received yet. But when you're doing your accounting for your company, to understand whether you're making money or losing money, you really want to do it on an accrual basis. And here's the reason why. Cash basis accounting takes advantage of what's happening in your bank, the money that you're receiving and the money that you're paying out. If, for instance, you had one customer and that customer didn't pay you for 3 months, in spite of the fact that you were selling them product for 3 months, you would have no sales for those 3 months. And then if they paid you in one lump sum at the end of those 3 months, you would get one large check from them and you'd have a huge amount of profit because you had all that income coming in. On the expense side, it's the same way. Your expenses are really the money that you're paying out. So if you didn't pay any bills for a month or 2 months, you'd be making a lot of money. But if you paid a lot of money to cover all those past due payments that you've been waiting on, you would pay that all in one month, and you may very well have a loss registered in that month because of all the cash that's going out of your business. Well, on that kind of a recording of your financial transactions, how do you have any idea whether you're making money or losing money? Because it's only based on when money is coming into or going out of your business. Well, that's not going to tell you whether you should expand or contract, hire or fire, buy more inventory or less inventory. And it's certainly not going to tell you whether you're making money on the products that you're selling. So if we do it on an accrual basis, what you're doing is really matching transactions that are occurring at the time they occur. And you're matching the revenue to the expenses that relate to that individual transaction. So if you have an invoice you send out, that's a sale. And the expenses that are related to that sale are the expenses for the staff that did the work for it. The expenses include the manufacturing or the services that you've provided and the cost of you producing those services. And it doesn't have anything to do with when you paid the bill. It only has to do with when you did the work. So the situation is that you want to align those expenses and those revenues so that they all line up on the same days or the same weeks or the same months in which they occurred. You want to align those expenses and revenues because accrual accounting cares for when transactions occur. It doesn't care about when you received the money or sent the money out. And if you do things that way on an accrual basis, you'll have accurate financial reporting that'll allow you to tell clearly whether you're making money or losing money.